So I want to do a little bit more practice. We would have done a team question on one of these, but not all of, maybe not all of them. We'll see by the time you watch this video. Hopefully you will see it before at least a couple of the team questions. These are questions from the spring 2019 exam, final exam, and there's 3 of them. The first one is a question related to the capital asset pricing model. Come up with a discount rate for your stock. The second one is valuing stocks using those 3 models that you'll do in paper 3 and 4, and paper 4 really, capitalized earnings model, constant growth model, and the H model. Third is a bond valuation problem, which we would have already done in a team question before this video, for this class anyway. And then the last one is a relative value question. So let's see if we can get through a couple of these in this session, and then next class we'll do a few others. So what we have to do is figure out the discount rate for this stock, and so this isn't given on the exam, so you have to remember that CAPM says the discount rate is the risk-free rate plus beta times the market risk premium. If you don't have this formula memorized backwards and forwards, learn it. This is one of those formulas every business major knows. So you definitely want to know it. So here we're using the forward 10-year treasury rate, which is 3%. So your boss says that she likes to use the forward curve. So whatever she uses, down below we have a list of interest rates including the 10-year. The actual 10-year at the time I did this exam was 2.6%, but she's saying we don't use the actual 10-year. Remember that third approach I gave you on paper 3, so that's 3%, plus beta times the market risk premium. Well, the market risk premium, she uses the implied approach. So remember the implied approach, she wants to get the expected return on stocks. Remember that's the dividend yield plus expected earnings growth. So here she has a couple of dividend yields. She's trying to value Nordstrom stock. The current dividend yield on the stock market is 2%, but on Nordstrom stock is 3%. Well, you don't use your company's stock dividend for the market risk premium. You want to look at the overall stock market. So that's 2%. And then, now she does an adjustment for buyback yield, so that makes your current income 3%. So if she adds back something for buyback yield, remember I said we didn't need to do that in paper 3, but and here she does it. So she makes adjustments, so she has a dividend yield. So if you see a buyback yield, you just add it to the dividend yield. So her current income yield is 3%. And she thinks corporate earnings are going to grow 5%, so that's 0.05. So she thinks the stock market's going to make 8%. So what is her market risk premium? Remember the market risk premium is expected return on stocks. Really, it's the required return on stocks. Remember with the implied approach, we calculate the expected return on stocks and use that as a substitute for the required return on stocks. So it's really the required return on stocks to be perfectly consistent with the theory, minus the risk-free rate. So her market risk premium is 8% minus 3% or 5%. So we're going to use 5% there. And then we kind of come up with a beta. Well, this is Nordstrom. They're a retail company. They're a higher end retail. So remember on beta, the 4 things you'll put in there are revenue sensitivity. So this is consumer, retail, high-end. So it's definitely a cyclical stock with a beta well above 1. So we start that. The second thing is we're going to look at operating leverage. So what we have down here is we see that their net margin standard deviation is actually pretty low. Their net margins are not that volatile, much lower than the S&P. is lower than average given low standard deviation of net margins, so might push beta closer to 1. We're not going to push it below 1. This is definitely a cyclical stock, so we'll get closer to 1. And then we'll look at financial leverage. So we look at their debt. Their debt is quite high. Very high debt, 280% versus 72% for the S&P 500 stocks. It's actually the Russell 3000, but that's okay. Pushing the beta up away from 1. And the last thing is history. So we look at the history. The history is down here. We can see that their median beta is about 1.4. It recently has been much lower. This is only through 2008. It's gotten close to 2. It's been below 1 for some time, but I'm going to say history suggests 1.40. I'm going to use 1.4 given that it's cyclical. And remember, when you come with financial, you need to include all of them. Low operating leverage offsetting high financial leverage. So the history median seems consistent with these 3 inputs. Something like that's what we're looking for. So we'll use 1.4. So our beta is 1.4. And when we do all of that, we get a KE of exactly 10%. Just happened to work out 10%. 3% plus essentially 7%, so 10% is our discount rate. So that would be your answer. Your answer is all of this. All of this needs to be in your answer. Same thing when you did the team competition. Hopefully you did all of this. So there's the answer to that first one. So if our discount rate is 10%, we bring that forward into this question. And all we got to do is plug in some numbers here. So the cap earnings, you remember that is EPS times 1 plus inflation divided by KE minus inflation. Remember the dividend discount model is dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. And then the H model is we just bring the dividend discount model over. It's the exact same number. What we're going to do, we're going to add this little section in the middle. Hopefully this is all coming back to you. I love the H model. Plus dividend 0 times H times growth short-term minus growth long-term. Divided by the same thing. So here we have earnings per share. You can see this is earnings per share 0 because the last 12 months, that's 3.00 times 1 plus inflation. Our inflation is 2%. You see that up there. Divide that by 10% minus 2%. Make sure you put everything in decimals. When you do all of that, you should get a price of 42.08. For dividend discount model, we have dividend 0, which is $1.50, times 1 plus long-term growth. The long-term growth assumption is 5%. You see that right there. Divided by 0.1 minus 0.05, your discount rate minus your long-term growth. When you do that, you should get $31.50. It is possible to get a value less than the cap earnings with the dividend discount model. And then with the H model, we can copy the dividend discount model down Put it in the next line. Plus dividends times the H. So what is the H here? We say the continued growth in commerce for Nordstrom has shown strong success. That was true before the COVID virus, obviously. Earnings will be 10%, there's their short-term growth, over the next year to move back to long-term growth over 6 years. So you've got 6 years and you have 10%. So growth short-term is 10% and your H is 1/2 of whatever that period of time is. So your H is 3. So you take your short-term growth rate 10% minus your long-term growth rate 5%. You put all that in there and you should get a price that's higher because your short-term growth rate is higher than your long-term growth rate. You should get a higher number than your dividend discount model, and I get $36. So there's your answer for that one. And so I'll stop the class there. Some good practice for the final. And then we'll start next class. So we'll work through these last 2 problems for the next class. You would have already had the team question for this one, and probably this will be the team question for this particular class. So hopefully you watch the videos in advance of class and you'll be ready for that. And hopefully you'll be ready for the bond team question. So we'll leave it there mainly because we're going to have a couple of live sessions that I want to count that time as part of class time so we don't go over the 75 minutes. So I'll stop it there. Hopefully that's helpful. And then next time we'll start right there.